$40 trillion. That is the number the U.S. Treasury Department confirmed this week, and it did not creep up on schedule the way most economists expected. It arrived early, months ahead of forecasts, and part of the reason it got here faster involves a Supreme Court ruling most people have not connected to their own daily finances yet. In this script, we are breaking down exactly who the U.S. government actually owes this money to, why the number jumped up faster than projected, and what this milestone actually means for anyone living in the U.S. right now, not just for economists and bond traders. Let's start with the raw numbers, because the headline figure of $40 trillion is really two very different categories of debt combined into one total, and understanding that split is the key to understanding everything else in this story. The Treasury Department reported the national debt officially surpassed $40 trillion, and as of this specific milestone, roughly 80% of the total, close to $32 trillion, is what is called debt held by the public. The remaining 20%, around $8 trillion, is called intragovernmental debt. These two categories work completely differently, and mixing them up is where a lot of confusion about the national debt comes from. Debt held by the public means money borrowed from actual outside investors, people, institutions, foreign governments, and companies that bought U.S. Treasury bonds, bills, and notes as investments, expecting to be paid back with interest. This is real money borrowed from real lenders outside the federal government, and it is the category economists generally treat as the more meaningful measure of the country's actual financial exposure, since it represents genuine obligations to outside parties. Intragovernmental debt is different. This is money one part of the federal government owes to another part of the federal government, primarily reflecting IOUs the Treasury has issued to trust funds like Social Security over the decades. For years, Social Security collected more in payroll taxes than it paid out in benefits, and instead of that surplus sitting in a vault somewhere, the government borrowed it and spent it on other things, issuing special Treasury securities to the Social Security Trust Fund in exchange. That trust fund technically owns those securities, and the government technically owes that money back to the trust fund. But because this is the government borrowing from itself, economists generally agree it does not carry the same real-world financial risk as money borrowed from actual outside lenders. It matters for the future of Social Security specifically, but it does not affect the government's day-to-day cash flow or its relationship with financial markets the way the public debt does. So, focusing specifically on that roughly $32 trillion in debt held by the public, who actually holds it? This is where the real answer to who Washington owes gets interesting, because it is not the answer most people assume. The single largest holder of U.S. debt is not a foreign government. It is the Federal Reserve, the United States' own central bank. The Fed currently holds somewhere between $4.3 and $4.5 trillion in U.S. Treasury securities, acquired mainly through large-scale bond buying programs the Fed ran during the 2008 financial crisis, and again during the COVID-19 pandemic, buying Treasury bonds specifically to keep interest rates low and support the economy during those emergencies. That single holding, the Fed's $4+ trillion, is actually larger than the combined holdings of the three largest individual foreign creditor nations, Japan, the United Kingdom, and China, put together. After the Federal Reserve, the next largest categories of holders are domestic financial institutions and investment vehicles. Mutual funds hold the single largest chunk among these groups, at roughly $5.2 trillion, reflecting strong ongoing demand for Treasury bonds as a safe, liquid place to park money, especially inside retirement accounts and everyday investment portfolios that millions of Americans hold without necessarily realizing a chunk of their retirement savings is directly invested in U.S. government debt. Beyond mutual funds, other major domestic holders include pension funds at over $1 trillion, commercial banks and depository institutions holding just over $2 trillion, state and local governments holding around $1.6 trillion, and a broad category of other corporate and individual lenders accounting for $6.6 trillion more. Add all of that up, and you start to see the actual shape of who Washington owes. It is not primarily foreign adversaries or geopolitical rivals holding America's debt hostage. It is largely American institutions, American retirement funds, American banks, and the American central bank itself, all holding pieces of this debt as part of the ordinary, everyday functioning of the financial system. This is worth sitting with for a moment because it directly contradicts a fairly common assumption people have about the national debt. The idea that America is somehow financially beholden primarily to foreign powers who could theoretically use that leverage against the country. The reality is considerably more mundane and in some ways more reassuring, even if it does not fully eliminate legitimate concerns about the overall scale of the debt. The vast majority of the money is owed to American citizens, American companies, and American institutions, meaning the country's own retirement savings, banking system, and financial stability are directly tied to the health of this debt, not primarily some external actor's goodwill or restraint. Now let's talk about the foreign side specifically, since that is usually where public attention and anxiety tends to focus first. As of the most recent data, foreign governments and foreign investors combined hold somewhere between 23 and 32% of the debt held by the public, depending on exactly how the calculation is measured and which specific snapshot in time you are looking at. That is a meaningful chunk, but it is nowhere near a majority, and it is worth being precise about which specific countries actually hold the largest shares. Japan is the single largest foreign holder of U.S. debt, holding somewhere around $1.2 trillion, or roughly 12 to 13% of all foreign-held U.S. debt. The United Kingdom comes in second, holding close to $900 billion. China, despite the outsized attention it typically receives in conversations about U.S. debt, actually ranks third among foreign holders, at around $680 billion, representing roughly 7% of foreign holdings. That is a meaningful decline from where China stood just a few years earlier. Back in December of 2020, China held over $1 trillion in U.S. debt, representing about 15% of all foreign holdings at that time. China has been steadily reducing its Treasury holdings for several years running, for a mix of reasons, including diversifying its own foreign currency reserves and broader geopolitical tension between the two countries. This steady decline in China's Treasury holdings is worth understanding in a bit more depth, because it is frequently framed in political commentary as a deliberate adversarial move, China supposedly abandoning U.S. debt as some kind of economic warfare tactic. The reality is more layered than that framing suggests. Part of the shift reflects China actively working to diversify its massive foreign currency reserves across a broader range of assets, rather than concentrating so heavily in U.S. Treasury securities, specifically, a reasonable risk management strategy any large holder of financial assets might pursue over time, regardless of the specific bilateral relationship involved. Another part of the shift reflects broader economic and political tensions between the two countries that have made both sides somewhat more cautious about deepening financial interdependence in this specific form. Untangling exactly how much of the decline reflects deliberate strategic distancing versus ordinary portfolio diversification is genuinely difficult from the outside, and analysts covering this topic tend to describe it as some combination of both factors rather than attributing it entirely to one single motivation. It is also worth understanding a technical wrinkle in how foreign holdings actually get measured, because it complicates the picture of exactly which country holds what. The Treasury Department estimates foreign holdings based on where the securities are physically custodied, meaning which country's financial institutions are holding the paperwork, rather than based on the actual nationality of the ultimate investor who owns the underlying asset. This means some of the largest reported foreign holders are actually international financial centers, places whose banking systems specialize in holding assets on behalf of clients based in entirely different countries. Luxembourg, for example, regularly appears among the top foreign holders of U.S. debt, despite being a small country with a relatively modest economy, precisely because of its role as a global financial hub handling investments on behalf of clients located elsewhere. This makes it genuinely difficult to determine with full precision exactly how much U.S. debt is held by residents of any single specific country, beyond the official government holdings that are more directly traceable. Foreign holdings can also be split into two different types worth distinguishing: official holdings and private holdings. Official holdings mean the money is held directly by foreign governments and their central banks, currently making up a little under 42% of total foreign holdings, or somewhere around $3.9 trillion. Private holdings, meaning foreign banks, foreign companies, and individual foreign investors buying Treasury bonds as a personal or corporate investment choice, rather than as an act of government policy, make up the larger remaining share, around 58%, or roughly $5.4 trillion. This distinction matters because it shows that a meaningful portion of foreign-held U.S. debt is not really about foreign governments strategically financing America. It is simply private investors around the world choosing U.S. Treasury bonds as a reliable, safe place to invest their own money, the same basic reasoning that drives American mutual funds and pension funds to hold Treasury bonds too. So, pulling this together, here is the honest, complete answer to who Washington actually owes. Roughly 20% of the total $40 trillion is owed internally, from one part of the government to another, primarily through the Social Security Trust Fund. Of the remaining 80% owed to genuine outside lenders, the single largest holder is America's own central bank, the Federal Reserve. After that come American mutual funds, pension funds, banks, state and local governments, and individual investors, representing the clear majority of the money owed to outside parties. Only after all of that do you get to foreign governments and foreign private investors, who collectively hold meaningfully less than a third of the public debt, spread out across dozens of countries, with no single nation, including China, holding anywhere close to a majority or even a dominant plurality on its own. Now, let's talk about why this number arrived faster than expected, because this is where a genuinely significant recent legal development comes into play. Forecasters had generally expected the debt to cross the $40 trillion mark sometime later in 2026. It got there months earlier than that timeline anticipated, and a meaningful part of that acceleration traces directly back to a Supreme Court ruling that struck down a large portion of the Trump administration's tariffs. Here's the mechanism connecting those two seemingly unrelated events. Tariffs function as a form of tax revenue for the federal government, money collected from importers bringing goods into the country, which then flows into the Treasury's general revenue. When the Supreme Court ruled that a significant share of those tariffs had been imposed without proper legal authority, the government was not only forced to stop collecting that revenue going forward, it was also required to refund tariffs that had already been collected, since those collections were retroactively determined to have been imposed illegally. That refund obligation alone came to more than $100 billion in import taxes the Treasury had to pay back. Combine the lost future revenue with the retroactive refund obligation, and you get a meaningful acceleration in how quickly the government's overall deficit, and therefore the total debt, grew compared to what had been forecast just months earlier. This detail matters because it shows how a single legal ruling, one that most people primarily think about in terms of trade policy and tariffs on imported goods, can ripple directly into the government's overall fiscal position, accelerating a milestone like this by months. It is a useful reminder that the national debt is not simply a slow, steady, predictable number climbing at a fixed rate every year. Specific policy decisions, court rulings, and unexpected legal outcomes can meaningfully speed up or slow down exactly when milestones like this actually arrive. Beyond that specific tariff-related acceleration, there are broader, longer-running structural forces driving the overall growth in debt that go back much further than this one court ruling. The government's spending on programs like Social Security and Medicare continues to grow steadily, driven by an aging population that requires more benefits paid out relative to the working population, contributing payroll taxes into these systems. At the same time, successive rounds of tax cuts going back to legislation passed during Trump's first term that cut the corporate tax rate from 35% down to 21% reduced the amount of revenue coming into the Treasury relative to what it would have collected under the previous tax structure. Combining rising mandatory spending obligations with reduced tax revenue is precisely the kind of structural mismatch that produces persistent, growing deficits year after year, regardless of which specific administration happens to be in office at any given moment. It is worth being direct about the political dimension of this discussion as well, since budget and debt topics tend to get caught up quickly in partisan framing. Following this milestones announcement, the current administration reportedly sought to attribute the ballooning deficit specifically to the opposing political party, while budget analysts more broadly tend to point towards structural factors spanning multiple administrations and controlled by both parties at various points. Aging entitlement programs whose costs have grown under presidents from both parties, and tax policy changes enacted under both Republican and Democratic administrations over recent decades. One research organization focused specifically on federal debt calculated that, adjusted for inflation, President Obama's 2 terms saw the national debt increase by roughly $13.2 trillion in current dollar terms, while President Trump's first term added about $9.8 trillion, and his second term has already added more than $3.5 trillion just 18 months in, a pace that would put his total increase ahead of Obama's if it continues at anything close to its current rate through the remainder of his term. These figures illustrate that debt growth has been a persistent bipartisan pattern across recent administrations, not something attributable to any single party or president in isolation, even as each side tends to emphasize the other's contributions when the topic comes up publicly. It is worth putting some additional numbers around exactly how large this year's deficit actually is. Government spending is expected to exceed tax revenue by more than $2 trillion this year alone. That is not a one-time gap. It reflects the ongoing pattern that has been pushing the total debt higher year after year. And it explains why the debt crossed the $39 trillion mark only about 5 months before crossing this most recent $40 trillion milestone, an unusually short gap between 2 consecutive trillion-dollar increments compared to historical patterns. Now, let's get into why any of this actually matters for someone who is not an economist or a bond trader, because the honest answer is that it already does matter. In ways that show up in everyday costs, most people do not immediately connect back to the national debt. The most direct, immediate impact is interest payments. The U.S. government now pays approximately $1.1 trillion annually just to service the interest on its existing debt. To put that in perspective, that figure now exceeds the entire budget of the Department of Defense. Interest payments have also recently surpassed federal spending on health insurance programs, making interest now the second largest single category of federal spending, trailing only pension and retirement benefit spending like Social Security. In the current federal budget year specifically, interest costs are on pace to consume about 19% of all federal tax revenue collected, a share that analysts expect to continue climbing in the years ahead. Every dollar the government spends servicing interest on existing debt is a dollar that cannot be spent on anything else, whether that is infrastructure, education, healthcare, defense, or any other government priority. As that interest burden grows as a share of the federal budget, it increasingly crowds out room for other spending or forces the government to borrow even more just to cover the interest payments themselves, a genuinely uncomfortable cycle where debt increasingly finances the cost of servicing previous debt. This dynamic sometimes gets described using the phrase compounding debt, and it is worth walking through why that description is accurate rather than just alarmist language. When a government has to borrow additional money, specifically to cover interest payments on money it already borrowed previously, that new borrowing itself then accrues its own additional interest charges going forward. Left unaddressed over a long enough time frame, that compounding effect can cause the total debt to grow at an accelerating rate, even without any new major spending programs or additional tax cuts being introduced. This is part of why budget analysts pay such close attention to the specific share of the federal budget consumed by interest payments, rather than only focusing on the headline debt total itself, since a rising interest burden is often a leading indicator of accelerating future debt growth, even before that acceleration fully shows up in the total headline number. There is also a more indirect, but arguably more immediately painful, way this affects ordinary people, through interest rates on everyday borrowing. As the national debt grows and investors start demanding higher returns to keep lending the government money, that pushes up interest rates more broadly across the entire economy, not just for government borrowing specifically. The average rate on a 30-year mortgage recently approached 6.7%, a figure directly connected to this broader dynamic of rising government borrowing costs rippling out into private lending markets. Higher mortgage rates mean higher monthly payments for anyone buying a home, and similarly, elevated rates show up across car loans, credit cards, and business borrowing as well. As one budget expert put it plainly, federal debt is already raising the cost of living for ordinary Americans, not through some abstract, distant mechanism, but through concretely higher borrowing costs on the loans people actually take out for houses, cars, and everyday expenses. There's also a longer-term risk worth understanding, even though it has not fully materialized yet. As government debt continues climbing relative to the overall size of the economy, currently sitting at roughly 126% of GDP, there is a growing risk that private investment could get crowded out, since a larger and larger share of available capital in financial markets gets absorbed by government borrowing rather than flowing into private businesses and investment opportunities. Analysts have also flagged the theoretical risk of more extreme outcomes if the debt trajectory continues unchecked indefinitely, ranging from persistently higher inflation to a genuine loss of investor confidence in U.S. government debt as the safe, reliable asset it has traditionally been treated as. None of those more extreme scenarios have actually happened yet, and it is worth being clear about that distinction. But the trend itself, rising debt, rising interest costs, and a growing share of the federal budget consumed simply by servicing past borrowing, is already measurably affecting the economy today, well before reaching any of those more dramatic hypothetical breaking points. It is also worth understanding how historically unusual this current level of debt relative to the size of the economy actually is. The current debt to GDP ratio has only been matched once before in American history, during the extraordinary borrowing that financed the country's involvement in World War II. That comparison is worth sitting with. The last time the country carried debt at this scale relative to its overall economic output, it was financing a global war effort widely understood at the time as an existential national emergency. Today's debt, by contrast, reflects structural, ongoing budget patterns during a period without any comparable singular emergency driving the borrowing, which is part of why budget analysts describe today's growth in the debt as fundamentally structural rather than tied to any specific crisis or emergency spending need. Looking forward, official government projections do not show this trend reversing anytime soon. The Congressional Budget Office has estimated the gross national debt will climb to somewhere around $63.7 trillion by the end of fiscal year 2036, with the debt to GDP ratio expected to rise past 135% by that same point. Those are projections, not guarantees, and actual outcomes could shift based on future policy changes, economic growth rates, interest rate movements, or unexpected events. The same way this most recent $40 trillion milestone arrived faster than earlier forecasts anticipated because of the tariff-related court ruling. But absent some significant change in either spending patterns or revenue collection, the underlying trajectory points toward continued, sustained growth in the total debt for the foreseeable future. It is worth understanding what would actually need to change to meaningfully alter this trajectory, since it is a genuinely different set of policy options than people sometimes assume. Because such a large share of federal spending is tied up in programs like Social Security, Medicare, and interest payments themselves, all of which are either legally mandated or contractually obligated, rather than subject to the same annual budget negotiations as other government spending. Meaningfully reducing the deficit generally requires either significant reform to those large mandatory spending programs, meaningful increases in tax revenue, sustained periods of unusually strong economic growth that outpaces the growth in debt itself, or some combination of all three. Analysts across the political spectrum broadly agree that relying on economic growth alone, without any changes to either spending or revenue, is unlikely to be sufficient, given the current scale of the structural gap between what the government spends and what it collects in tax revenue each year. So, bringing this all together, here is the real complete picture behind this $40 trillion milestone. Roughly a fifth of it is money the government owes to itself, mainly through the Social Security Trust Fund, a bookkeeping obligation rather than a market-facing financial risk. Of the remaining roughly $32 trillion owed to genuine outside lenders, the single largest holder is the Federal Reserve, America's own central bank, followed by a broad range of domestic institutions, mutual funds, pension funds, banks, and individual investors that together dwarf the total held by any foreign government. Foreign holdings do exist and are meaningful, led by Japan, the United Kingdom, and China in that specific order, but they represent well under a third of the public debt overall, spread across dozens of countries rather than concentrated in the hands of any single geopolitical rival. This particular milestone arrived earlier than expected, specifically because of lost tariff revenue and refund obligations following a Supreme Court ruling, layered on top of longer-running structural pressures from aging entitlement programs and reduced tax revenue following previous rounds of tax cuts. And the real-world impact is not some distant, abstract concern reserved for economists. It already shows up today in the form of trillion-dollar annual interest payments now exceeding the defense budget, and in elevated borrowing costs that are directly pushing up everyday expenses like mortgage rates for ordinary Americans right now. That is the real documented story behind this milestone, based on Treasury Department data, Congressional Budget Office projections, and analysis from budget-focused research organizations across the political spectrum. Whatever happens with future spending and tax policy from here will determine whether this trajectory continues largely unchanged, or whether some combination of policy changes eventually alters the path the country is currently on.